Chapter 2 focus on planning with personal financial statements. We're going to first look at how do I create what's known as a personal cash flow statement. We're going to identify what factors are going to influence my personal cash flow statement. We'll then move from the personal cash flow statement and prepare what's known as a budget. And we're going to end the chapter by preparing what's known as a personal balance sheet. So this entire chapter focuses on creating different types of personal financial documents. So you ready? Let's go. So with the personal cash flow statement, what is it? Well, it is a statement that shows a person's cash inflows as well as their cash outflows. From an inflow standpoint, let's make this personal. I want you to think about what are your sources of income. For most of us, it's going to be our job. So the income received from our employer, whether it's every week, every 2 weeks, once a month, will go up under the cash inflow section of our personal cash flow statement. Now, when you're recording income, it should always be shown net, meaning that when you're recording your income from your employer, do not record your gross income amount, but your actual net income amount or your take-home pay. Because you can't spend gross, right? You can only spend your actual take-home pay. And maybe you have other income sources. Perhaps you do something on the side, whether it is painting houses, cutting grass, doing Mary Kay, you name it. Perhaps you have investments. You're going to cash in some stocks. You have interest coming in from your checking account, savings account. Whatever source of income that you're receiving, you want to list those sources on your personal cash flow statement. Then you have your expenses, both large and small. So record all of your expenses on your personal cash flow statement, whether it's your mortgage, your car note payment, utility bills, your food expense, clothing expense, entertainment, whatever you're spending money on, you want to document it and list all of your expenses on your personal cash flow statement. By preparing the personal cash flow statement, it will allow us to see whether we have what's called a surplus or a deficit at the end of a certain period of time. Meaning that at the end of the month, am I going to have some money left, or will I have more bills than money? We'll then take the personal cash flow statement, prepare what's known as a budget. So now we want to focus on how do I budget for the upcoming accounting period so that I do not have a deficit at the end of the next accounting period. So we'll look at that as well. Here we have a sample of a personal cash flow statement. Notice the top portion shows the different sources of cash inflows, whether it's going to be income from an employer, interest on deposits, dividends. Again, there could be rental income coming in. Whatever income source that you have, you want to list the income. If there are tax implications, list the income after taxes. So for our example, this is for Stephanie for last month. She had total income of $2,500. Next, we're going to list all the expenses that took place during the following month. So now record keeping becomes very important. You want to make sure that you keep track and document all of your expenses for the appropriate time period. So we listed expenses for rent, internet, groceries, car expenses, recreation, etc. Her expenses totaled $2,100. For this particular month, at the end of the month, there was a positive net cash flow in the amount of $400. $400. Therefore, Stephanie earned more than what she spent and had a surplus at the end of the month in the amount of $400. Now, that was showing her actual information for last month. A budget is a forecast. It is a cash flow statement that forecasts future cash inflows and future cash outflows. We are going to anticipate the amount of money we expect to receive in the upcoming time period and the expenses or outflows that are going to take place. It's a budget, so we don't know exactly, but certain things you do know. So if you're paid, say, for example, salary, you pretty much know how much your take-home pay is going to be. There's what we call fixed expenses, your mortgage, your rent, your car note payment. Total expenses, you know exactly how much it's going to be every month. Other items like your utility bills, your food allowance, even clothing, those items are going to fluctuate, and they're referred to as being variable expenses. But list both your fixed and variable expenses on your budget. So the first column is what we did before. That's a personal cash flow statement that shows the actuals from last month. Now this would be our budget, where we're going to anticipate or forecast what's going to take place in a future accounting period. So notice that the income stays the same, pretty consistent, but we're recognizing a potential increase in healthcare insurance and expenses and an increase in car expenses. So maybe we understand that we're going to have some work done on our vehicle, so we're anticipating higher core expenses in the upcoming month than the previous month. So based upon our projections for this month, we're going to have a net cash flow of a negative $200. So now we must ask ourselves, because of this negative cash flow, do we have funds in reserve? Do we have money saved already, so that when we have this negative cash flow for this current month, we have funds available to take care of this negative amount? What we do with budgeting, which is very important, you want to actually record all of your transactions. So here's a forecast. It's our budget. This is what we expected to take place for the month. This is what actually took place. Okay? So notice that the income was the same, but for our expenses, the expenses end up being $100 higher than what we anticipated. The forecasting error will show if there's a variance, that we call a variance, and the expenses or the income, the difference. So we see that we spent more on clothing than what was expected, a difference of $70, and we spent more on recreation than what was expected as well. And from a grocery standpoint, we spent a little bit less. Now, the good news about this budget is that when it comes to clothing and recreational, those items are not necessarily something that we have to purchase every month. So what we can do, we see that we spent more than what we should have. Going forward, that clothing and recreational budget amount can actually be decreased. But the key is to monitor your budget. If we know that for clothing, the amount is going to be $75, we want to make sure that we don't spend over that dollar amount for clothing items. Now, if your budget is typical it's a typical month, meaning that there really wasn't any type of variances per se or anything out of the ordinary, possibly you could just take those monthly projections, multiply times 12 to prepare what's known as an annual budget. Okay? That's only if those numbers were typical of what you expect to take place in the upcoming 12 months. If you know that, well, that month was unique, or I don't expect to spend as much or have as much income, then when preparing your annual budget, take it month by month showing total for those 12-month time period, your total inflows, total outflows. At the end of the accounting period, will we have a positive net cash flow or will we have a negative net cash flow? A personal balance sheet is a balance sheet that summarizes your assets, things that you own, and your liabilities, what you owe. The difference between your assets minus liabilities will show us your actual net worth. So with the personal balance sheet, have you ever wondered, what is my current net worth? So to do that, to find it out, look at all of your assets, determine what are the value of those assets, look at all of your liabilities, what do I owe, and the difference is known as your net worth. So here we have a sample balance sheet for Stephanie. She's showing her assets, liquid assets, meaning that they're in the form of cash or can be converted into cash in a short period of time. Her household assets, as well as her investment assets. So her assets total $9,000. Her liabilities, only thing she has a liability, she's doing great, would be her credit card balance. Therefore, her net worth, assets minus liability, is a total of $7,000. So do this for me. Take out a sheet of paper, list all of your personal assets, list all of your liabilities, current and long-term. Current meaning that these items will become due within 1 year from your balance sheet date. If it's long time, these liabilities become due in a time period longer than 1 year from your balance sheet date. And determine what is your particular net worth. Okay? So that's a brief summary of the items we're going to cover in Chapter 2, Planning with Personal Financial Statements. If you have any questions on these topics, feel free to contact me.